There is a simple, almost childlike question that, when answered with brutal honesty, has the power to unlock levels of success and wealth that seem almost mythical. It is the question that separates the frantic, busy, and ultimately mediocre from the calm, focused, and legendary. Warren Buffett, a man who has built an empire on the foundation of simplicity, has centered his entire life around this question. And the core of it, the genetic code of his genius, can be distilled into a single, devastatingly effective mental model. It's called the 20-slot rule. Imagine, from the moment you begin your professional life, you are handed a punch card. It has only 20 slots on it, 20 holes to be punched. And each time you make a major investment, a significant career change, or commit to a new business venture, you have to punch one of those slots. Once all 20 are punched, that's it. You're done, you get no more. How would that change the way you make decisions? Would you still jump on that hot stock tip from your brother-in-law? Would you still launch that fifth side hustle because you have a fear of missing out? Would you still take that job that offers a 10% raise but pulls you away from your core mission? Of course not. You would treat each decision with the gravity it deserves. You would research, you would deliberate, you would wait. You would wait for the absolute perfect pitch, the opportunity so good, so certain, that it is worthy of one of your 20 precious, irreplaceable slots. This is not just a clever thought experiment. This is the operating system that runs in the background of Warren Buffett's mind every single day. It is the antidote to the disease of modern ambition, the frantic, unfocused pursuit of more. We are told that success is about saying yes, about seizing every opportunity, about diversification and hustling. Buffett's entire legacy is a testament to the exact opposite. It is a monument to the power of saying no to almost everything. This is not a guide to time management. It is a strategy for wealth creation, a blueprint for executive decision-making, and a manual for building a life of consequence by concentrating your finite energy on the very few things that truly matter. We are about to deconstruct this powerful mental model into 5 fundamental pillars, each one a load-bearing column in the architecture of extraordinary achievement. We will explore the deep psychology that makes it work, the practical steps to apply it to your own life, and the financial devastation that awaits those who ignore its wisdom. Prepare to fundamentally rewire the way you see opportunity. Prepare to learn that the secret to getting everything you want is to want and to do almost nothing. This is the final promise of focus. The first and most foundational pillar of the 20-slot rule is the deliberate and often uncomfortable embrace of scarcity. Not a scarcity of resources, but a scarcity of choice. It is the understanding that imposing strict limitations on yourself is not a handicap, but the most powerful catalyst for high-quality decision-making. We live in a world that worships abundance, a digital fire hose of opportunities, ideas, and potential investments. The 20-slot rule is a shield against this deluge. It is a self-imposed framework that says, quote, "My attention, my capital, and my time are among the rarest assets in the universe, and I will allocate them as such." This principle of imposed scarcity forces a radical shift in mindset, from an opportunistic hunter chasing every rustle in the bushes to a patient apex predator waiting for the one perfect, high-value target to wander into its kill zone. To truly understand how this mindset was forged in the bedrock of Buffett's investment philosophy, we must travel back to 1972. This wasn't the era of the globally celebrated Omaha icon. This was Warren Buffett, the brilliant but still largely regional manager of Berkshire Hathaway, a struggling textile mill he was transforming into a diversified holding company. His partner, the intellectual powerhouse Charlie Munger, was running a similar entity called Blue Chip Stamps. Together, they were looking for businesses to buy, but their methodology was still heavily influenced by their mentor, Benjamin Graham. They were cigar butt investors, looking for discarded companies that had one last free puff left in them, terrible businesses at wonderful prices. Then, an opportunity crossed their desk that would forever change their approach and perfectly illustrate the power of selective, scarcity-driven decision-making. The opportunity was See's Candies. It was a beloved, family-owned California candy company with a fiercely loyal customer base and a strong brand. The See family wanted to sell, and the asking price was $30 million. The company was earning about $2 million after tax, meaning they were asking for a multiple of 15. To Buffett and Munger, steeped in the cigar butt school of buying assets for less than their liquidation value, this was heresy. The company's tangible assets, its factories, its inventory, were only worth about $8 million. The other $22 million was for something they couldn't touch or see: the brand, the customer loyalty, the goodwill. Buffett's initial reaction was a hard no. It violated every principle he had learned from Graham. Why pay a premium for intangibles when you could buy textile mills for less than the value of their machinery? But Munger was insistent. He saw something deeper. He understood that a powerful brand was an economic moat, a fortress that protected the business from competition. He argued that a wonderful business at a fair price was superior to a fair business at a wonderful price. This was a moment of intense debate, a crucible for their evolving investment strategy. They had finite capital. This wasn't a small bet. A purchase of this size would consume a significant portion of their available funds. It would be a major punch on their metaphorical card. They couldn't afford to be wrong, and they couldn't afford to do this deal and 5 others like it. They had to choose. The scarcity of their capital forced a higher level of intellectual rigor. They weren't just running numbers. They were debating the very nature of value. In the end, they negotiated the price down to $25 million. Buffett, still feeling a bit queasy, agreed. That single decision, born from the pressure of limited capital and the need to make one correct, significant choice rather than a dozen small ones, became the turning point for Berkshire Hathaway. See's Candies went on to generate over $2 billion in pre-tax earnings for Berkshire over the subsequent decades, requiring very little additional capital investment. It was an absolute home run, but more importantly, it taught Buffett and Munger the most valuable lesson of their careers: the immense power of paying up for quality. It recalibrated their entire definition of a punch-worthy opportunity. Had they had unlimited funds, had they been operating under a mandate to diversify and make dozens of investments a year, they might have bought a dozen more mediocre textile mills. They would have spread their capital and attention thinly across a portfolio of cigar butts. Instead, the scarcity of their resources forced them to confront a difficult, paradigm-shifting idea. It forced them to say yes to one thing, and in doing so to say no to an entire universe of cheaper but ultimately inferior opportunities. That single decision to punch the card for See's Candies laid the intellectual groundwork for their later, titanic investments in Coca-Cola, American Express, and Apple. It was a masterclass in the power of imposed scarcity. The reason this principle of imposed scarcity works is not just a matter of financial discipline. It is a profound psychological hack that exploits and overrides some of the most powerful biases hardwired into the human brain. The modern world presents us with what psychologists call the paradox of choice, or overchoice. The prevailing belief is that more options lead to greater freedom and better outcomes, but study after study reveals the opposite to be true. When we are faced with too many choices, our cognitive machinery begins to break down. We experience decision paralysis, a state where the sheer volume of options is so overwhelming that we fail to make any choice at all. Or, if we do make a choice, we are often less satisfied with it, plagued by the ghost of the opportunities we rejected. The 20-slot rule is a direct assault on the paradox of choice. By artificially and dramatically reducing the number of acceptable options from potentially thousands to a mere 20, it liberates the mind from the burden of infinite possibility. It's like being in a restaurant with a 50-page menu versus one with only 5 expertly curated dishes. In the latter, you are far more likely to make a confident, satisfying choice. The mental model also masterfully leverages the scarcity heuristic. This is a cognitive shortcut our brains use where we attribute greater value to things that are rare or limited. A sold-out concert feels more desirable than one with empty seats. A limited edition product commands a higher price. The 20-slot rule applies this heuristic not to a product, but to our own decisions. When you truly internalize that you only have 20 slots, each one becomes incredibly precious. The act of punching the card is elevated to a momentous occasion. This changes the entire emotional and cognitive calculus of decision-making. You are no longer asking, "Is this a good idea?" You are forced to ask a much more powerful question. Is this idea good enough to be one of the only 20 I will ever have? This reframing instantly raises the bar for what you are willing to say yes to. Furthermore, this mental model serves as a powerful defense against what is perhaps the most destructive psychological bias in business and investing, the fear of missing out, or FOMO. FOMO is a manifestation of social proof and herd mentality. We see others getting rich on a new trend, be it tech stocks, cryptocurrencies, or real estate, and we feel an intense anxiety that we are being left behind. This anxiety hijacks our rational brain, the prefrontal cortex, and puts our more primitive, emotional limbic system in the driver's seat. We abandon our strategy and leap into the herd, often at the precise moment of maximum risk. The 20-slot rule acts as a circuit breaker for this impulse. When the urge to chase a hot trend strikes, the rule forces a sobering question. Is this speculative chase truly worthy of a permanent slot on my lifetime card? The answer is almost always a resounding no. It re-engages the rational brain, reminding you that your strategy is not to catch every wave, but to catch the few, massive, predictable tides. It provides a pre-committed psychological anchor in the midst of a market storm, allowing you to observe the frenzy with detachment rather than participating in it with desperation. This is a core component of a high-performance success mindset. It is the ability to regulate emotional responses to external noise. So how do you take this powerful psychological principle and turn it into a practical tool, a concrete blueprint for your own life and business? The application of the 20-slot rule is an exercise in discipline and visualization, a mental model that can be implemented starting today. The first step is to make the abstract tangible. Don't just think about a punch card. Create one. Take a physical index card or a sheet of paper. Draw 20 circles on it. Label it with your name and lifetime punch card. If you're more digital, create a simple document with the numbers 1 through 20. Put this document on your desktop or print it out and place it on your wall where you will see it every single day. The physical or visual representation is critical because it moves the concept from a fleeting idea to a concrete reality. It becomes a constant reminder of the scarcity you have imposed upon yourself. The second step is to define with absolute clarity what constitutes a punch. This is the most important part of the process and requires deep introspection. A punch is not for buying lunch or choosing a vacation spot. A punch represents a major allocation of your 3 most precious resources: capital, time, and focus. For an investor, a punch might be defined as any investment that consumes more than 5% of your total investment capital. For an entrepreneur, a punch could be the decision to launch a new company, to enter a significant new product line, or to undertake a major strategic pivot. For a professional, it might be changing jobs or committing to a new career path. You must write down your definition of a punch at the top of your card. Be specific. For example, a punch is 1. An investment of over $50,000, 2. The start of a new business venture, or 3. A change in my primary employment. This definition becomes your constitution. The third step is to integrate this into your decision-making process through a technique called the gravity check. Whenever you are faced with a potential punch-worthy decision, you must stop and perform this ritual. Pull out your card, look at the empty slots. Now, ask yourself a series of brutal questions. Is this opportunity so good, so clear, so within my circle of competence, that I am willing to permanently sacrifice 1/20th of my life's major decisions for it? If I punch this slot, am I prepared to hold this investment or commit to this path for at least a decade? Can I, right now, articulate the reasons for this decision so clearly that I could convince a skeptical panel of experts? This process forces a pause. It injects a dose of long-term thinking into a world that rewards short-term reaction. It forces you to make the case to yourself, to become your own devil's advocate. The fourth and final step is to maintain an anti-portfolio or a rejection journal. This is a log of all the major opportunities you considered, but, because of the 20-slot rule, chose to say no to. Next to each rejected opportunity, write a brief sentence about why it didn't meet the standard of a punch. Over time, this journal will become one of your most valuable assets. You will see the speculative fads you wisely avoided. You will see the mediocre business ideas that would have drained your energy. This journal provides positive reinforcement for your discipline. It proves that the value of the 20-slot rule lies not just in the few great things you do, but in the thousands of good but not great things you wisely choose not to do. This is not just a tool for investors. It is a framework for leadership, for entrepreneurship, and for crafting a life of focused excellence. To fully appreciate the wisdom of this scarcity mindset, we must examine its opposite, the path of the 99%. This is the path of the perpetually busy, the eternally optimistic opportunist, who believes that more activity automatically leads to more progress. This is the world of the unfocused, driven by the siren song of more. The individual on this path lives in a state of chronic FOMO. Their guiding principle is not, "Is this a truly great opportunity?" but, "What if this is the next big thing and I miss it?" This mindset leads to a disastrous pattern of behavior. In investing, it creates the collector. This is the person whose portfolio looks like a stamp collection, with 50 or 100 different tiny positions. They own a sliver of every hot tech stock, a few shares of a friend's recommendation, a small position in a speculative cryptocurrency. They are diversified to the point of absurdity. They have achieved what Buffett's partner Charlie Munger calls diversification. They have ensured that even if one of their bets is a spectacular winner, its impact on their overall net worth will be negligible. They have protected themselves from ruin, but they have also guaranteed themselves a future of mediocrity. Their activity gives them the illusion of being a sophisticated investor, but in reality they have admitted through their actions that they have no high-conviction ideas. In entrepreneurship, this antithetical path creates the shiny object chaser. This is the entrepreneur who has a dozen projects in the works. They have an e-commerce store they work on for a few hours a week, a half-written book, a podcast with 3 episodes, and an idea for a revolutionary new app they just need to find a developer for. They attend every webinar, buy every course, and are constantly networking, but they never gain traction on any single front. Their energy and focus are so thinly distributed that no single venture ever reaches escape velocity. They mistake motion for progress. Their business card is a laundry list of hustles, but their bank account reflects the profits of a hobbyist. The psychological trap here is that being busy feels productive. Telling people about all your projects feels impressive. But this is a facade. The reality is a deep-seated fear of commitment. Committing to one big project means saying no to all the others. It means accepting the risk of focused failure. The path of the 99% is a hedge against that risk, but it's also a hedge against massive success. It is a strategic choice to play for a small, safe win, which almost always results in a slow, certain loss against inflation and time. This person's time management is a chaotic mess of context switching, putting out fires, and reacting to inbound requests, with no deep work or sustained effort on the 1 or 2 things that could actually move the needle. This is the path of least resistance, and it leads exactly where you'd expect, to a destination of average. The financial connection between the 20-slot rule's scarcity mindset and building real generational wealth is not just theoretical, it is direct, quantifiable, and profound. The impact can be seen on your balance sheet, in your portfolio's performance, and in the very economic engine of your business. First, consider the direct and visible costs of hyperactivity. The path of the 99% is incredibly expensive. The investor with 100 stocks is constantly trading, racking up commissions, fees, and, most importantly, short-term capital gains taxes, which are taxed at a much higher rate than long-term gains. Each transaction is a small drain on their capital, a frictional cost that acts as a powerful headwind against performance. The entrepreneur chasing shiny objects is bleeding cash on a dozen fronts: website hosting for 5 different ideas, software subscriptions for multiple projects, small marketing budgets spread so thin they have no impact. These small leaks over time can sink the entire ship. The 20-slot rule, by its very nature, minimizes these frictional costs. Fewer decisions mean fewer transactions. Longer holding periods mean capital gains are deferred and, when realized, are taxed at a more favorable long-term rate. A singular business focus means capital is concentrated on one proven model, not squandered across a dozen experiments. But the more powerful financial connection is invisible and far more significant: the opportunity cost of diluted focus. Let's quantify this with a simple scenario. Imagine 2 investors, each with $100,000. Investor A, following the path of the 99%, diversifies across 50 different stocks, putting $2,000 in each. Investor B, following the 20-slot rule, waits patiently and, after deep research, invests her entire $100,000 into just 2 companies, putting $50,000 in each. Both are skilled, and their best ideas generate a fantastic 20% return in a year. For investor A, her best-performing $2,000 position earns her $400. It's a win, but it barely moves the needle on her total portfolio. For investor B, her $50,000 position earns her $10,000. That is a life-changing return. They both had the same level of skill in picking a winner, but the financial outcome was radically different simply because of their allocation strategy. Investor B's wealth management strategy was designed for concentration in excellence, while Investor A's was designed for participation in mediocrity. The same mathematics applies to entrepreneurship. An entrepreneur's time is their most valuable capital. If you have 100 hours of productive work per week, and you spread it across 5 projects, each one gets 20 hours, it's not enough to compete. But if you pour all 100 hours into your single best idea, you create an unstoppable force. You can outwork, outthink, and out-execute your less focused competitors. This is how market leadership is born. The financial result of this concentrated effort is a business that grows faster, achieves profitability sooner, and builds a sustainable competitive advantage. This is the direct path to financial freedom. The 20-slot rule is therefore not just a philosophical stance, it is a mathematical imperative. It recognizes that in life and in business, returns are not evenly distributed. A tiny fraction of our decisions will account for the vast majority of our results. The rule is a mechanism designed to force us to ignore the trivial many and focus all our resources on the vital few. That is the direct financial connection, and it is the secret to moving from incremental gains to exponential wealth. The second pillar that rises from the foundation of the 20-slot rule is the active, relentless, and unapologetic discipline of deliberate omission. If the first pillar is about creating a mindset of scarcity, this second pillar is about the real-world action that this mindset demands, the constant and consistent act of saying no. This is perhaps the most misunderstood and poorly executed aspect of high performance. Most people believe that success is a function of what you add to your life: more projects, more investments, more connections. Buffett's entire career, however, demonstrates that extraordinary success is often a function of what you subtract. It's about having the courage to deliberately omit the good in order to have the capacity to embrace the truly great. This is not passive avoidance. It is an aggressive strategic filtering of reality. It requires defining the boundaries of your competence with glaring honesty and then defending those borders like a fortress. The most powerful illustration of this principle in Buffett's life is not a story of a brilliant investment he made, but of an entire category of investments he famously and stubbornly refused to make: the tech stocks of the dot-com bubble. To understand the sheer force of will this required, we must transport ourselves to the late 1990s. The world was gripped by a speculative mania, unlike anything seen in decades. The internet was changing everything, and a new breed of company, with names like Pets.com, Webvan, and GeoCities, was achieving astronomical valuations without ever having turned a profit. Financial gravity itself seemed to have been suspended. Any company that added .com to its name saw its stock price soar. It was a national obsession. Against this backdrop of euphoric easy money, Warren Buffett and Berkshire Hathaway looked like relics from a bygone era. They continued to invest in insurance companies, furniture stores, and seize candies. Pundits and analysts openly mocked him. Magazine covers ran headlines like, "What's wrong, Warren?" He was called a dinosaur, a man who just didn't get it. The pressure to join the party was immense, not just from the media, but from his own shareholders, who were watching their neighbors get rich on stocks that doubled every few months. At the annual Berkshire Hathaway meetings, he was peppered with questions. "Warren, why aren't we in tech? Are you missing the biggest wealth creation event in history?" Buffett's response was always calm, consistent, and a masterclass in deliberate omission. He would explain his concept of the, quote, circle of competence. He said, "I don't know what the world will look like in 10 years, and I don't know what these internet companies will be earning, but I do know that people will still be chewing Wrigley's gum, and I know they'll be drinking Coca-Cola." He admitted, openly and without shame, that he did not understand the technology or the business models of these new companies. He couldn't project their cash flows with any degree of certainty, and therefore they fell outside his circle of competence. So he said no. He said no to Cisco, which was briefly the most valuable company in the world. He said no to Microsoft. He said no to Intel. He said no to hundreds of IPOs that were making overnight millionaires. This was not a passive no. It was an active, disciplined, and publicly defended no. He was punching 0 slots on his card for an entire sector that was captivating the global economy. Then, in March of 2000, the bubble burst. The Nasdaq index, which had peaked at over 5,000, began a catastrophic collapse. Over the next 2 years, it would lose nearly 80% of its value. Trillions of dollars of speculative wealth evaporated. The high-flying dot-coms went bankrupt. The people who had mocked Buffett as a dinosaur saw their portfolios vaporized. And Berkshire Hathaway, holding its portfolio of boring but profitable businesses, saw its value hold steady and then climb. Buffett wasn't a genius because he predicted the crash. He was a genius because he had the discipline to admit what he didn't know. He built a fortress of no around his circle of competence and simply refused to be lured out into the speculative battlefield where he had no edge. This episode is the ultimate testament to deliberate omission. Saying no to the dot-com bubble was a more powerful and wealth-preserving decision than any single yes he could have possibly made during that period. It was the triumph of self-discipline over social proof, the victory of a clear mental model over market hysteria. The psychological machinery that makes deliberate omission so difficult, yet so powerful, is rooted in our deepest social and cognitive biases. The primary antagonist is herd mentality, also known as social proof. As social creatures, we are wired to find safety in numbers. If everyone around us is doing something, buying a certain stock, adopting a new technology, chasing a business trend, our brain interprets this as a signal that it must be the correct thing to do. To stand apart from the herd is to invite social ostracism and risk, which our evolutionary past has taught us to fear. The dot-com bubble was a textbook example of social proof in action. The rising stock prices were the proof that the new paradigm was real. The media stories of instant millionaires were the proof. Your neighbor's success was the proof. To resist this requires an immense amount of internal fortitude. Buffett's circle of competence is a psychological tool designed to counteract this very bias. It's a pre-commitment. By defining in advance what you know and what you don't know, you create an objective standard against which to judge opportunities. When the herd stampedes towards a new, exciting field that falls outside your circle, your pre-commitment acts as a brake. It allows you to say, "This may be a great opportunity for someone else, but it is not for me, because it violates my rules." This transforms the decision from an emotional one, fear of missing out, to a rational one, adherence to a system. Another powerful bias at play is what's known as the action bias. This is the human tendency to favor action over inaction, even when inaction is the more rational course. In uncertain situations, we feel a compelling urge to do something. A goalkeeper in a penalty shootout is more likely to dive to one side, even though statistics show they'd have a better chance of saving the goal by staying in the center. Diving feels more proactive. Similarly, in a bull market, investors feel they must be constantly buying. Entrepreneurs feel they must be constantly launching. Inaction feels like incompetence or laziness. The discipline of deliberate omission is a direct rebellion against the action bias. It is the recognition that sometimes the most profitable and intelligent action is no action at all. It is the wisdom to sit patiently with cash, waiting for the perfect opportunity, rather than deploying it into a mediocre one just for the sake of being in the market. This requires a redefinition of what work looks like. For Buffett, work is not trading, it is reading and thinking. For a high-performance entrepreneur, work should not be starting new projects, it should be perfecting the core business. Saying no allows for the deep, focused work that true mastery requires. It's a conscious choice to trade the satisfying but ultimately fruitless flurry of activity for the less glamorous but infinitely more rewarding pursuit of excellence in a narrow domain. This is a crucial element of executive decision-making. Knowing when the most powerful move on the board is to simply pass your turn and let others make mistakes. Translating the discipline of deliberate omission into a practical, applied mental model for your own life requires more than just willpower. It requires a systematic process. This blueprint, which we can call the fortress of focus, consists of 3 key steps: defining your perimeter, installing your gatekeeper, and celebrating your omissions. The first step, defining your perimeter, is the famous circle of competence exercise, but with a degree of rigor most people fail to apply. Take a blank sheet of paper and draw a large circle in the middle. Inside this circle, you are only allowed to write down the industries, skills, business models, and investment types that you understand with true, deep fluency. The test for inclusion is this: could you give a 90-minute lecture on this topic to a room full of intelligent people with no preparation? Could you hold your own in a debate against an expert in the field? Could you explain its key economics and competitive dynamics to a child? Be brutally honest. For most people, this circle will be surprisingly small. It might contain managing paid advertising for e-commerce, long-term rental real estate in the Midwest, or software-as-a-service business models with high switching costs. Outside the circle is everything else: cryptocurrencies, biotech, international shipping, venture capital. This document is your strategic map. The second step is to install your gatekeeper. Your gatekeeper is a simple 2-part question that every single opportunity must answer before it is even considered for analysis. The question is, 1. Does this fall squarely inside my circle of competence? And 2. Does this align with my long-term goals? This gatekeeper question must become an automatic, reflexive part of your thinking. When a friend pitches you a can't-miss real estate deal in a city you know nothing about, the gatekeeper immediately says no. When you read an article about a hot new stock in the biotech space, the gatekeeper says no. The goal is to automate the rejection of 99% of inbound noise. This isn't about deep analysis. It's about immediate filtering. The opportunities that pass this initial filter are the only ones that even earn the right to be considered for a potential slot on your punch card. This process dramatically reduces cognitive load and preserves your precious analytical energy for the few opportunities that actually matter. It's a time management and productivity superpower. The third and final step is to actively celebrate your omissions. As we discussed, this involves keeping a, quote, rejection journal. But it's more than just logging. It's about periodically reviewing this journal and appreciating the wisdom of your no's. When a speculative asset class you avoided crashes, make a note of it. When a competitor who chased a fad goes out of business, analyze why. This practice rewires your brain's reward system. Instead of getting a dopamine hit from the thrill of saying yes to something new, you begin to derive a sense of satisfaction and wisdom from the discipline of saying no. You start to see that your omissions, your anti-portfolio, are just as, if not more, important to your long-term success as your actual portfolio. This turns the painful act of self-discipline into a rewarding and reinforcing habit, making it a cornerstone of your success mindset. The antithesis to this disciplined approach, the path of the 99%, is to live with no circle of competence, no filter, and no fortress. This is the path of the intellectual dabbler. This individual prides themselves on being a generalist, on knowing a little bit about everything. Their motto is, "You have to be open to new ideas." While this sounds enlightened, in the world of high-stakes decision-making, it is a recipe for disaster. The intellectual dabbler is susceptible to every compelling story and every charismatic pitch. Because they have no clearly defined area of expertise, they have no anchor of true knowledge to protect them from the persuasive tides of narrative. When cryptocurrencies are soaring, they read a few articles, watch some YouTube videos, and convince themselves they are now knowledgeable enough to invest. When a new business model like dropshipping becomes popular, they consume a weekend's worth of content and believe they are ready to build an empire. They mistake surface-level familiarity for deep understanding. The financial consequences are devastating. They consistently buy into asset classes near their peak, after the story has become widely accepted and the easy money has been made. They are the ones left holding the bag when the narrative changes and the herd thunders out. In their careers, they are the quote, jack of all trades, master of none. They jump from role to role, industry to industry, always chasing what seems hot at the moment. They have an impressive-looking resume with a wide variety of experiences, but they never stay in one place long enough to build the deep, specialized expertise that commands true value in the marketplace. They never get to the second and third levels of understanding in any field, which is where the real insights and opportunities lie. The psychological state of the intellectual dabbler is one of constant, low-grade anxiety. Because they are always operating at the edge of their knowledge, they are insecure and highly susceptible to the opinions of others. They look for gurus, for hot tips, for shortcuts, anything to relieve them of the burden of independent thought. Their decision-making process is external, not internal. They are playing a game where the rules are set by others, and they will always be one step behind the people who have a deep, first principles understanding of the game they are in. This is not a path to high performance. It is a treadmill of intellectual and financial mediocrity, powered by the fear of being left out and the illusion of broad knowledge. The direct financial connection of practicing deliberate omission is stark, and can be summed up in one of Warren Buffett's most famous quotes: Rule number 1, never lose money. Rule number 2, never forget rule number 1. The primary financial benefit of saying no is not about maximizing gains, it is about avoiding catastrophic losses. A single large loss can be so devastating to a portfolio or a business that it can take years or even decades to recover from. The mathematics of loss is unforgiving. If you lose 50% of your capital, you need to achieve a 100% gain just to get back to where you started. If you lose 90%, as many did in the dot-com crash, you need a 900% return to break even, a feat that is almost impossible. Deliberate omission, by keeping you out of speculative manias and outside of your area of expertise, is the single greatest defense against these permanent impairments of capital. By saying no to the dot-coms, Buffett didn't just preserve his capital, he put himself in an extraordinary position of strength when the crash came. While others were forced to sell their good assets to cover the losses on their bad ones, Buffett was sitting on a mountain of cash, ready to provide liquidity to the market at favorable terms and to buy wonderful businesses at fire sale prices. This is a critical lesson in wealth management. The greatest opportunities often arise directly from the ashes of the mistakes made by others. By avoiding the popular mistake, you are not just playing defense. You are setting yourself up for the most powerful offense. On a business's income statement, the impact is equally direct. The entrepreneur who says no to chasing new product lines and instead focuses on perfecting their core offering will see higher profit margins. Why? Because focus leads to operational excellence. They get better at marketing their core product, which lowers customer acquisition costs. They get more efficient at delivering it, which lowers costs of goods sold. They build a stronger brand around that one thing, which allows them to command higher prices. Their income statement reflects this discipline. In contrast, the unfocused entrepreneur has a bloated expense line, with marketing, R&D, and operational costs spread across multiple, underperforming initiatives. The financial statement of a focused business is clean, efficient, and profitable. The financial statement of an unfocused business is a complex, bloated, and often money-losing mess. The discipline of deliberate omission, therefore, is not a passive act. It is an active strategy that directly protects your balance sheet from catastrophic risk, while simultaneously clearing the path for your income statement to reflect the high-margin results of true operational excellence. It is the financial manifestation of the wisdom that what you don't do is often the primary driver of your net worth. The third pillar of the 20-slot rule framework is the establishment of an unassailable threshold of conviction. Once you have embraced scarcity and learned to say no to almost everything, the question becomes, what is the standard for saying yes? If you only have 20 slots for your entire life, you cannot afford to use one on a maybe or a pretty good idea. A slot can only be punched for an opportunity in which you have developed a level of conviction that is so deep, so well researched, and so intellectually sound that it borders on absolute certainty. This is not about arrogance or being a know-it-all. It is the opposite. It is about a profound humility, the humility to know that you can only achieve this level of certainty in a very, very small number of areas, and then having the discipline to do the immense work required to get there before committing. It's about raising the bar for a yes so high that almost nothing can clear it. The quintessential story of Buffett's quest for unassailable conviction takes us back to the fall of 1963. It's a tale that has become legend in investment circles, the American Express salad oil scandal. At the time, American Express was a respected blue-chip company, primarily known for its travelers' checks and credit card businesses. But it also had a lesser-known division involved in warehousing, where it would issue receipts against stored goods, which companies could then use as collateral for loans. One of its biggest clients was the Allied Crude Vegetable Oil Company, run by a man named Tino DeAngelis. DeAngelis had devised a massive fraud. He was borrowing huge sums of money against receipts for giant vats of salad oil that, as it turned out, were mostly filled with seawater. When the fraud was discovered, Allied Crude Vegetable Oil collapsed, defaulting on over $175 million in loans. Wall Street panicked. American Express had guaranteed the receipts. It appeared the company was on the hook for a loss that could potentially wipe out its entire net worth. The stock, which had been trading at over $60 a share, plummeted to $35 in a matter of weeks. Fear and uncertainty gripped the market. Analysts predicted bankruptcy. This was the epitome of a blood-in-the-streets moment. While the rest of Wall Street was selling in a panic, Warren Buffett, then managing his small investment partnership in Omaha, saw a potential opportunity. But he didn't just buy the stock because it was cheap. He embarked on a relentless, on-the-ground investigation to build a level of conviction that no Wall Street analyst, sitting in a Manhattan skyscraper, could ever hope to achieve. He didn't just read the annual reports. He became a detective. He went to restaurants and travel agencies, observing whether people were still using American Express cards and traveler's checks. He interviewed employees. He talked to merchants. He even went to the banks that were American Express's competitors to see if they were seeing a drop-off in their rival's business. He was trying to answer one critical question. Had the scandal damaged the underlying consumer behavior that powered the company's real profit centers? His scuttlebutt investigation revealed that the American Express brand, in the minds of the consumers and merchants, was completely insulated from the obscure warehousing scandal. People were still using the cards and checks as if nothing had happened. He concluded that the core business, the economic franchise, was intact and immensely valuable. Armed with this ground-level, unassailable conviction, he did something that would have been unthinkable to any practitioner of modern portfolio theory. He invested 40% of his partnership's entire capital into American Express stock. It was the single largest investment he had ever made. He didn't just punch a slot on his card, he hammered it with a sledgehammer. Over the next few years, as the company settled the scandal-related claims for far less than feared, and the power of its core business reasserted itself, the stock price soared. The investment was a grand slam for Buffett's partners, netting them millions. This story is the perfect embodiment of the third pillar. It wasn't a bet. It was a conclusion based on rigorous, independent work. He ignored the screaming headlines and the panic of the crowd and focused only on the fundamental business reality. The threshold for punching that slot was not, "This looks cheap," or "This might go up." The threshold was, "I understand the reality of this situation better than the market does, and I am willing to stake a huge portion of my net worth on that understanding." That is the unassailable threshold of conviction. The psychological principles that this pillar navigates are among the most powerful and perilous in the human cognitive landscape. When a dramatic, negative event like the salad oil scandal occurs, our brains fall victim to the availability heuristic. This is our tendency to overestimate the likelihood of events that are more recent, more memorable, or more emotionally charged. The story of the fraud was dramatic and widely reported, so in the minds of most investors, it loomed larger than the mundane day-to-day reality of millions of people using traveler's checks. Buffett's method is a direct antidote to this bias. His on-the-ground research was a way of replacing the emotionally charged, available narrative of the scandal with a mountain of boring, but far more relevant data points about actual consumer behavior. He was deliberately making the true fundamental reality more available to his own mind. This process also serves as a powerful defense against fear contagion. Fear, much like a virus, is highly transmissible in social settings, and a stock market panic is a perfect vector. When we see others panicking, our mirror neurons fire, and we begin to feel their fear, which often leads to us joining the sell-off without any rational analysis. This is a primal, survival-based instinct. To overcome it, you need an intellectual anchor that is stronger than the emotional pull of the crowd. Buffett's deep, independent research served as that anchor. His conviction wasn't based on what others thought, it was based on facts he had personally verified. This allowed him to view the market's fear not as a signal to sell, but as the very source of the opportunity itself. He was buying the fear of others. Furthermore, building this level of conviction is an exercise in overcoming the Dunning-Kruger effect, a cognitive bias where people with low ability at a task overestimate their ability. Many amateur investors, after reading a single article, believe they understand a company well enough to invest. Buffett's process reflects the wisdom of an expert who understands that true knowledge requires immense effort. His deep dive into American Express was an admission of his own initial ignorance and a reflection of the hard work needed to move from surface-level understanding to genuine mastery. This is the essence of a true success mindset, the intellectual humility to know what you don't know, combined with the ferocious work ethic to learn what can be known. The process of building conviction is therefore a process of de-biasing your own mind, of systematically replacing lazy, emotional System 1 thinking with rigorous, analytical System 2 thinking. To apply this pillar and build your own unassailable threshold of conviction, you need to adopt the investigative journalist mental model. This model transforms you from a passive consumer of information into an active, skeptical seeker of ground truth. It is a step-by-step process for stress testing an opportunity before you would ever consider punching a slot for it. Step 1 is to become the prosecution. Before you allow yourself to articulate the reasons why an investment or business venture might be a good idea, you must first build the strongest possible case against it. You must actively seek out dissenting opinions, bearish reports, and critical reviews. You must ask yourself, what are the 5 most likely ways this could fail catastrophically? Then, you must research each of those potential failure points until you can argue the bearish case better than the bears themselves. This process, known as creating a pre-mortem or killing the company, inoculates you against confirmation bias, our natural tendency to seek out information that confirms our pre-existing beliefs. Only after you have failed to kill the idea can you allow yourself to explore its merits. Step 2 is to demand primary evidence. The investigative journalist does not rely on second-hand reports. Wall Street analyst reports, news articles, and expert opinions are all secondary sources. Primary evidence is the raw material. For an investment, this means reading the last 5 years of annual and quarterly reports yourself. It means listening to the earnings calls. It means using the company's product or service, talking to its customers, and, if possible, speaking with its employees or competitors. For an entrepreneur starting a business, it means getting out of the building and talking to at least 50 potential customers before writing a single line of code or ordering any inventory. You must generate your own data, your own ground truth that is independent of the prevailing narrative. Step 3 is the explain it to a child test. Take your complex investment thesis or business plan and try to explain it in simple terms, using no jargon, to a 10-year-old. Could you make them understand why this company has a durable competitive advantage, or why your new business will create real value for its customers? If you cannot, it is a clear sign that you do not understand it well enough yourself. Albert Einstein famously said, "If you can't explain it simply, you don't understand it well enough." This test mercilessly exposes fuzzy thinking and forces you to distill your conviction down to its essential, undeniable core. A decision only becomes worthy of a punch on your card after it has survived this gauntlet. You have failed to kill it. You have verified it with primary evidence, and you can explain it with absolute simplicity. This is the blueprint for building conviction that is not just an opinion, but a deeply held evidence-based conclusion. The path of the 99% stands in stark contrast to this rigorous model. The antithesis of the investigative journalist is the hot tip taker. This individual's decision-making process is entirely externalized. They are constantly on the lookout for a shortcut, a secret piece of information that will give them an edge without the hard work of independent thought. They buy a stock because a charismatic pundit on television recommended it. They invest in a real estate project because their friend said it was a sure thing. They start a business in a particular niche because a guru in an online course promised it was the next big trend. They are essentially outsourcing the most important decisions of their life to people whose incentives and knowledge base are completely unknown to them. The hot tip taker is a believer in narratives. They are drawn to compelling stories, the revolutionary technology that will change the world, the undervalued asset that's about to be discovered. They fall in love with the story without ever doing the due diligence on the numbers or the underlying business reality. Their research consists of reading a few bullish articles that confirm the exciting narrative they've already bought into. This makes them exceptionally vulnerable to market manias and speculative bubbles. They are the eager buyers at the peak, drawn in by the exciting story of endless riches, and they become the panicked sellers at the bottom when that story falls apart. For the entrepreneur on this path, they are constantly chasing trends instead of solving fundamental problems. One year they are building a subscription box company. The next they are trying to launch an NFT project. The year after they are all in on an AI-powered app. Their strategy is dictated by whatever is trending on social media. Because their conviction is shallow and borrowed from others, it shatters at the first sign of adversity. When the business doesn't take off immediately, they quickly lose faith and jump to the next hot tip, never building the resilience or expertise that comes from sticking with a single problem long enough to solve it. The psychological root of this behavior is a desire for certainty without effort. The real world is messy and complex. Building true conviction is hard, time-consuming work filled with ambiguity. The hot tip promises a clean, easy answer. It is a cognitive painkiller, offering a temporary feeling of confidence and excitement without the side effects of critical thinking and hard work. It is, ultimately, a path of intellectual laziness, and the financial results reflect this lack of rigor with brutal accuracy. The direct financial connection between developing an unassailable threshold of conviction and building wealth is the concept of the margin of safety, the cornerstone of Benjamin Graham's and Warren Buffett's entire philosophy. The margin of safety is the difference between the intrinsic value of a business and the price you pay for it. A high level of conviction allows you to calculate this intrinsic value with a reasonable degree of confidence. The market's fear and panic, as seen in the salad oil scandal, is what creates a wide margin of safety by pushing the price far below that intrinsic value. Let's quantify this. Imagine your deep research gives you the conviction that the intrinsic value of American Express was, say, $60 per share. When the market panicked and offered you shares at $35, you had a $25 per share margin of safety. This is your buffer against bad luck, errors in judgment, and unforeseen events. If you were slightly wrong and the true value was only $50, you still had a massive cushion. The hot tip taker, having done no work, has no idea what the intrinsic value is. They are simply buying at 60 because the story is good and selling at 35 because the story is bad. They are guaranteed to lose money. Your conviction allows you to act counter-cyclically. It gives you the courage to be greedy when others are fearful. This is not just a clever aphorism. It is the fundamental mechanism of wealth transfer in financial markets. Wealth is not transferred from the patient to the impatient. It is transferred from those with no conviction to those with unassailable conviction. This principle has a direct impact on your portfolio's rate of return. Over a lifetime, the person who only makes 20 high-conviction investments when the margin of safety is wide will astronomically outperform the person who makes hundreds of low-conviction bets. Their returns will be lumpier, but their long-term compound annual growth rate will be in a different stratosphere. In a business context, conviction translates into staying power. The entrepreneur who has deep conviction in the problem they are solving will have the grit to persevere through the inevitable troughs of sorrow and uncertainty. This perseverance is what allows the business to survive long enough to find product-market fit and scale. The financial result is a business that actually reaches profitability and generates free cash flow, while the trend-chasing entrepreneur is stuck in a perpetual cycle of startup costs and write-offs. Conviction, therefore, is the engine of long-term compounding. It is what allows you to buy the right asset at the right price, and for an entrepreneur, it is what gives you the fortitude to build a business that endures. It shows up on the balance sheet as equity, built not by speculation, but by the slow, steady, and certain application of well-researched, high-conviction decisions. Following the rigorous standard of conviction, the fourth pillar of the 20-slot rule emerges, the strategic imperative of concentration. This is where the philosophy translates into audacious action. If you have done the work to build an unassailable level of conviction in an opportunity, the logical, and indeed the only rational course of action, is not to take a small tentative position. It is to bet big. The 20-slot rule is inherently a framework for concentration, not diversification. Traditional financial advice, hammered into the heads of millions, preaches the gospel of diversification as the ultimate virtue. Don't put all your eggs in one basket. Buffett's approach, reserved for those who are willing to do the work, is the polar opposite. His advice is to find one or two incredibly strong baskets, watch them like a hawk, and then put almost all of your eggs in them. Concentration is the acknowledgement that your best ideas are exponentially more valuable than your 10th best idea. Therefore, allocating capital and energy in a way that gives equal weight to both is a profound strategic error. Once an opportunity has cleared the sky-high bar of the first 3 pillars, it has earned the right to a significant commitment. A foundational anecdote that perfectly captures this pillar is Buffett's transformative investment in the Washington Post in the early 1970s. After the triumph of the American Express investment, Buffett continued to search for wonderful businesses at fair prices. In 1973, he found one in the Washington Post Company. At the time, the company was a media powerhouse, owning not just the iconic newspaper but also Newsweek magazine and several television stations. Its brand was globally recognized, particularly in the wake of its fearless Watergate reporting. However, the stock market was in the midst of a brutal bear market, and newspaper stocks were deeply out of favor. Wall Street saw them as old media, vulnerable to competition and high costs. The entire Washington Post Company had a market capitalization of around $80 million. Buffett, however, did his homework. He looked past the market's prevailing narrative and analyzed the underlying economics of the business. He saw that the newspaper had a virtual monopoly in a major affluent city, what he would later call a franchise. Its television stations were also local monopolies, veritable licenses to print money. He calculated that the assets, if sold off individually, were worth at least $400 million, maybe even $500 million. The market was offering him the chance to buy $1 for 20 cents. His conviction was absolute. But he didn't just take a small, sensible position. Starting in 1973, Berkshire Hathaway began buying shares aggressively. Over a period of months, he invested nearly $11 million, more than a quarter of Berkshire's entire net worth at the time, to acquire a huge block of the company's stock. This was a massive, concentrated bet. It was a definitive punch on his card. But his commitment went beyond just capital. He became personally involved. He took a seat on the board of directors and developed a deep friendship and advisory relationship with the company's legendary leader, Katharine Graham. He concentrated not just his firm's money but his own priceless time and intellect on this single investment. He was a true business owner, not a passive stock picker. That $11 million investment would, over the next 3 decades, grow to be worth over $1 billion. It became one of the cornerstones of Berkshire Hathaway's empire. This was not the result of a diversified portfolio of 50 media stocks. It was the direct result of having the courage to make a massive, concentrated bet on his single best idea in the entire sector. The Washington Post story is a powerful lesson. For the serious investor or entrepreneur, diversification is often a crutch, an admission of ignorance. If you truly don't know what you're doing, then diversifying is a way to protect yourself from yourself. But if you have followed the discipline of the first 3 pillars, if you operate from a mindset of scarcity, if you say no to almost everything, and if you have built unassailable conviction, then concentration is not a risk. It is the purest and most powerful expression of your hard-won knowledge. The psychological forces that make concentration so difficult are deeply ingrained in our nature. The most formidable is loss aversion, a principle discovered by psychologists Daniel Kahneman and Amos Tversky. Their research showed that the psychological pain of losing a certain amount of money is roughly twice as powerful as the pleasure of gaining an equal amount. This asymmetry makes us inherently risk-averse, even when the odds are in our favor. A concentrated strategy magnifies the potential for loss. If your single biggest investment goes down, the pain is acute and highly visible. A diversified portfolio, on the other hand, soothes our loss aversion. A single stock going down is masked by the small gains in others. It feels safer, even if the overall expected return is lower. To bet big, you must have a psychological framework that can override this powerful, primal fear of loss. Buffett's framework is his conviction. His deep understanding of the business and its wide margin of safety allows him to view price volatility not as a loss, but as a temporary fluctuation. He is anchored to his calculation of intrinsic value, not the market's daily quote. Another bias that pushes us toward diversification is what we can call the illusion of control. By spreading our bets, we feel like we are managing risk and are in control of our destiny. Concentration feels like a surrender of control, a leap of faith. But this is a fallacy. For the non-professional investor, owning 50 stocks means you have no real understanding or control over any of them. You are simply along for the ride. In contrast, the person who owns a significant stake in just 2 or 3 companies can dedicate the time and energy to truly understand them, to follow their progress, and to make informed decisions. True control comes from deep knowledge, not from a wide array of small, uninformed positions. Concentration is also an act of rebellion against the endowment effect, our tendency to overvalue things simply because we own them. In a diversified portfolio, an investor might hold on to dozens of mediocre companies for years, unable to sell them because they are part of the collection. A concentration strategy forces a ruthless pragmatism. To make a big new bet, you often have to sell something else. This forces you to constantly reevaluate your existing holdings and ask, is this still one of my absolute best ideas? This creates a dynamic, high-performance portfolio, where capital is continuously being reallocated to its highest and best use, rather than sitting stagnant in a museum of past decisions. Overcoming these biases requires a fundamental shift in identity. You must stop seeing yourself as a collector of assets and start seeing yourself as a capital allocator, whose sole job is to concentrate resources into the most productive and promising ventures. This is the mindset of a CEO, not a hobbyist. To apply the strategic imperative of concentration, you can use a powerful mental model known as portfolio pruning and power loading. This is a practical, 3-step blueprint for moving from a state of diffusion to one of focused power, applicable to both an investment portfolio and a portfolio of business projects. Step 1 is the forced ranking. List every single one of your investments, projects, or major time commitments. Now, you must force rank them from best to worst. The criteria for best should be clear. Which one has the highest potential for future returns, the strongest competitive advantage, and falls most squarely within your circle of competence? This is not an easy exercise. It forces you to confront the mediocre performers and the pet projects you've been clinging to for emotional reasons. You cannot have ties. There must be a clear number 1, number 2, and so on. Step 2 is the pruning. This is the most difficult but most crucial step. You must now commit to systematically selling off or shutting down the bottom half of your list. This will feel wrong. You'll be tempted to say, but this one might turn around, or I've already put so much work into this. This is the sunk cost fallacy at work. The pruning process is an act of liberation. You are freeing up 2 vital resources: capital and, more importantly, mental energy. Every item on the bottom of your list is not just underperforming. It is actively stealing focus and attention from the items at the top. This is a key principle of essentialism, the disciplined pursuit of less. Step 3 is the power loading. Take all the capital and mental bandwidth you've reclaimed from the pruning process and reallocate it to your top 1 to 3 positions or projects. This is the power loading phase. You are not just trimming the dead branches. You are redirecting all that water and sunlight to the strongest trunks. If your number 1 investment idea truly is your best, why does it only represent 5% of your portfolio? The model demands that you have the courage of your convictions and give it the capital allocation it deserves. If your core business is truly your most promising venture, why are you spending 10 hours a week on a speculative side project? Power loading means going all in on your proven winners. This process should not be a one-time event. It should be an annual or semi-annual ritual, a strategic review that ensures your allocation of resources always reflects your highest conviction ideas. It is the practical, hands-on application of CEO-level leadership to your own financial and professional life. The antithesis of strategic concentration is the jack-of-all-trades, master-of-none approach to capital and energy allocation. This is the path of the 99%, a path paved with good intentions and leading to the city of mediocrity. This individual operates under a fear-based model of decision-making. Their primary goal is not to achieve extraordinary returns but to avoid any and all discomfort. Diversification is their security blanket. In their investment portfolio, this manifests as owning a little bit of everything. They might have an S&P 500 index fund, an international stock fund, a bond fund, a real estate investment trust, and a small allocation to gold. This is a perfectly sensible strategy for someone who wants to be a completely passive investor and achieve average market returns. But the person on this path applies this same logic to their active pursuits, where it becomes a crippling handicap. As an entrepreneur, this is the person who hedges their bets by launching multiple brands or product lines at once, hoping one of them will stick. They create a portfolio of businesses, but because their attention and capital are spread so thinly, none of them receive the critical mass of resources needed to break through. Their marketing is diluted, their product development is slow, and their customer service is inconsistent. They are in a perpetual state of almost never achieving market leadership in any single category. The psychological driver for this behavior is a deep-seated fear of failure. By diversifying their efforts, they ensure that no single failure can be catastrophic. If one business fails, they still have the others. But in doing so, they also make truly massive success impossible. They have engineered a system that is designed to produce small, incremental results. They have chosen a life of low volatility and low returns. This mindset is often celebrated in our culture as being well-rounded or keeping your options open. But in the world of wealth creation, keeping your options open is often a synonym for a lack of commitment. It is a refusal to do the hard work of building deep conviction, and then backing that conviction with a meaningful allocation of resources. The path of the 99% is comfortable, it is defensible, and it is almost perfectly designed to ensure you will never have to experience the terror or the exhilarating triumph of going all in on your single best idea. The direct financial connection between strategic concentration and massive wealth creation is rooted in the mathematical principle of asymmetric upside. An asymmetric opportunity is one where the potential upside is many multiples of the potential downside. High-conviction investing, by its very nature, seeks out these opportunities. Buying a dollar for 20 cents, as Buffett did with the Washington Post, meant his downside was perhaps 20 cents, while his upside was 80 cents, an asymmetry of 4-to-1. But the real financial magic happens when you combine this asymmetry with concentration. Let's return to our example of two investors with $100,000. Investor A, the diversifier, puts $2,000 into a company with a 4-to-1 asymmetric upside. If it works, their $2,000 becomes $8,000 for a gain of $6,000. It's a great percentage return, but the dollar amount is small. Investor B, the concentrator, identifies the same opportunity and, after building conviction, invests $50,000. When it works, their $50,000 becomes $200,000 for a gain of $150,000. The financial outcomes are not just different, they are in different universes. Concentration is the amplifier that turns a good investment idea into a legacy-defining financial event. This is why nearly every one of the world's great fortunes, from Rockefeller's Standard Oil to Gates's Microsoft to Buffett's Berkshire Hathaway, was built on the back of a massive, concentrated position in a single, extraordinary business. They didn't get there by owning a diversified portfolio of 500 stocks. On a company's balance sheet, this principle manifests as a relentless focus on return on invested capital, ROIC. A focused company will only deploy capital into its core, high ROIC operations. The unfocused company will squander its retained earnings on what Buffett calls corporate adventures, ill-fated acquisitions, and new ventures that fall outside its circle of competence and generate poor returns. Over time, the focused company's balance sheet will swell with cash and retained earnings, while the unfocused companies will be burdened with goodwill from bad acquisitions and underperforming assets. The ability to generate high returns on capital and the discipline to concentrate capital only in those high-return areas is the single most important long-term driver of a company's intrinsic value. Strategic concentration, therefore, is not just a matter of portfolio theory. It is the core engine of compounding. It is the financial mechanism that allows a small amount of capital, combined with a few brilliant insights, to grow into a fortune of staggering proportions. It is the mathematical proof that when it comes to building truly transformative wealth, a few big, correct decisions are infinitely more powerful than a lifetime of timid, incremental ones. The fifth and final pillar, the capstone of the entire 20-slot rule architecture, is the profound understanding of the compounding force of permanent decisions. This pillar elevates the framework from a mere investment strategy to a comprehensive philosophy for life. It asserts that when you punch one of your 20 precious slots, the ideal holding period for that decision is forever. This is the ultimate antidote to short-term thinking. In a world that is obsessed with quarterly earnings, daily price swings, and the constant search for the next hot thing, the concept of permanence is a radical act. It requires a fundamental shift in perspective, from viewing your investments and commitments as tradable commodities to seeing them as pieces of a legacy you are slowly and deliberately building. A punch is not a trade. It is a marriage. It is a commitment made with the intention of lifelong partnership, based on the belief that the value of the enterprise, be it a business, a career, or a relationship, will grow and compound for decades to come. This long-term horizon changes everything. It changes the criteria you use to select opportunities, forcing you to favor businesses with durable competitive advantages and timeless products over those riding a temporary trend. It changes how you react to adversity, allowing you to view market downturns not as threats, but as opportunities to increase your ownership stake in the wonderful businesses you've already committed to. The most iconic story illustrating this pillar is Buffett's 1988 investment in the Coca-Cola Company. The backdrop was the infamous Black Monday stock market crash of October 1987. The market was still gripped by fear and volatility. Many investors were selling indiscriminately, desperate to get out. Buffett, characteristically, was hunting for bargains. He found one in Coca-Cola. For him, Coke was the perfect forever company. It had a brand that was recognized in every corner of the globe, a simple product that was beloved by billions, and a massive, entrenched distribution system that would be almost impossible for a competitor to replicate. It was, in his words, a business with a moat around it as wide as an ocean. He saw that while stock prices could fluctuate wildly, the desire of a person in a hot climate to have a cold, refreshing drink was a permanent feature of human nature. So over a period of several months in 1988, Berkshire Hathaway began to accumulate shares of Coca-Cola. He didn't just dip a toe in. Consistent with the pillar of concentration, he bought and he bought and he bought, until Berkshire had invested over $1 billion, making it by far the largest single holding in its portfolio. It was a monumental punch on his card, but the key to this story is not just the initial purchase, it's what happened next. For the next 30-plus years, he did nothing. He held the stock. Through recessions, through changes in management, through the introduction of New Coke and its subsequent failure, through countless market panics and booms, he held. He famously quipped, "Our favorite holding period is forever." That $1 billion investment has since paid Berkshire many billions of dollars in dividends alone, and the value of the stock itself has grown more than tenfold. It has been a geyser of cash, a compounding machine of almost unimaginable power. The Coca-Cola investment is the ultimate expression of the fifth pillar. The decision was permanent. The analysis was focused not on what the stock would do next quarter, but on whether the business would be selling more Coke in 10, 20, and 50 years. This long-term lens allowed him to see a value that short-term traders, obsessed with the market's daily mood swings, were completely blind to. It demonstrates that the greatest fortunes are not made by jumping in and out of the market, but by identifying a truly exceptional enterprise and then having the discipline and patience to simply sit tight and let the miracle of compounding do its work for you. The psychological bias that makes this pillar of permanence so difficult to practice is one of the most powerful forces in human nature: hyperbolic discounting. This is our innate tendency to prefer smaller, sooner rewards over larger, later rewards. We would rather have $20 today than $100 a year from now. This is the bias that makes us hit the snooze button for 10 minutes of extra sleep at the cost of a rushed and stressful morning. It's why people choose unhealthy foods for immediate gratification over the long-term reward of good health. In the financial world, hyperbolic discounting is a devastating force. It creates the trader's mindset. The allure of a quick 10% gain is far more emotionally compelling than the abstract concept of a 10,000% gain over 50 years. The daily feedback loop of the stock market, the flashing green and red numbers, is a powerful drug that feeds our desire for immediate gratification and feedback. The forever holding period is a direct assault on this bias. It requires you to completely detach from the short-term noise and to find your gratification not in the daily price quote, but in the slow, almost imperceptible growth of the underlying business's intrinsic value. It requires you to trade the adrenaline rush of action for the deep, quiet satisfaction of patience. This mindset also serves as a bulwark against what is known as recency bias, our tendency to overweight recent events when making predictions about the future. If a stock has gone down for the last 3 months, recency bias makes us feel like it will continue to go down forever. If a market has been in a bull run, we feel it will never end. A permanent mindset forces a much longer view. It prompts you to study not the last 3 months of a company's history, but the last 30 years. It forces you to ask questions about the durability of its competitive advantage over decades, not just over the next fiscal quarter. This long-view historical perspective dampens the emotional impact of recent events and allows for more rational, stable decision-making. Adopting a permanent mindset is an act of supreme self-discipline. It requires cultivating the ability to delay gratification on a massive scale. It means choosing the quiet work of studying business fundamentals over the exciting chatter of market speculation. It is the final and most difficult psychological hurdle to clear in the journey of a serious investor or entrepreneur, and it is the one that ultimately separates the merely successful from the truly wealthy. To translate the philosophy of permanence into a practical mental model, you can use a powerful exercise called the 10-year test. This is a simple but profound filter that you must apply to any decision before it qualifies for a punch on your card. It's a way to force a long-term perspective and combat the pull of hyperbolic discounting. Before making a major investment, launching a new business, or accepting a new job, you must sit down and write a short, compelling narrative of what that commitment will look like 10 years from now. The narrative must answer a series of specific questions. For a business investment, in 10 years, will this company's competitive advantage be stronger or weaker than it is today? Why? What are the major technological or cultural trends that could disrupt this business, and how likely are they to occur? Will the demand for this company's core product or service be significantly larger in a decade? Write a paragraph describing a day in the life of this company in the year 2034. For a career decision, in 10 years, will the skills I build in this role be more or less valuable in the marketplace? Are these skills transferable or specific to this one company? Does this career path offer a steep learning curve that will compound my human capital over the next decade? Will I be proud to have dedicated a significant portion of my life to this company's mission? This exercise is not about making precise predictions. The future is always uncertain. The purpose of the 10-year test is to force your brain to switch from short-term, tactical thinking to long-term, strategic thinking. It immediately filters out fads, get-rich-quick schemes, and opportunities based on temporary market conditions. A speculative investment might look great over a 6-month horizon, but it will almost certainly fail the 10-year test. A job that offers a high salary but little skill development will be exposed as a poor long-term choice. The test raises the quality of your yes. A true punch on your card should only be for an opportunity that not only passes the 10-year test, but has a narrative that genuinely excites you. You should feel a sense of profound optimism about the 10-year story you have just written. This model ensures that you are not just investing your money or your time. You are investing in a future that you have deliberately and thoughtfully chosen. A future where the relentless power of compounding is your greatest ally. This is the ultimate tool for building a life and a portfolio that are not just profitable, but durable. The antithesis to the permanent mindset is the trader's mentality, a pervasive and destructive approach that has infected not just financial markets, but career paths and business strategies as well. The trader lives in a world of immediacy. Their sole focus is on the next price move, the next quarterly report, the next career stepping stone. Their primary question is not, "What is this worth?" but "What will someone else pay me for this tomorrow?" The trader views assets not as ownership stakes in productive businesses, but as fleeting symbols on a screen to be bought and sold for a small profit. They are in a constant state of churn, always looking for an exit. This mindset is exhausting and, for the vast majority of people, financially ruinous. They are consistently whipsawed by the market, buying high on excitement and selling low on fear. They are playing a game against high-frequency trading algorithms and seasoned professionals, a game in which they have no competitive advantage. In the world of entrepreneurship, the trader's mentality manifests as the flipper. This is the entrepreneur who is not passionate about solving a problem or building a lasting company, but is solely focused on creating something that can be sold quickly. They chase whatever business model is currently in vogue for acquisitions, be it a direct-to-consumer brand or a software-as-a-service company. Their decisions are not guided by what is best for the long-term health of the business, but by what will look good to a potential acquirer in 18 months. This short-term focus often leads to cutting corners on quality, underinvesting in research and development, and creating a hollow, unsustainable business that looks good on the surface but has no real soul. In a career, this is the job hopper. This is the professional who changes companies every 18 to 24 months, always in search of a slightly higher title or a 10% salary increase. They build a resume, but they never build a legacy. They never stay long enough to see a major project through from conception to completion. They never build the deep institutional knowledge or the strong internal relationships that lead to true influence and leadership. They are in a constant state of interviewing and onboarding, never settling in long enough for their skills and contributions to compound within a single organization. The fundamental flaw of the trader's mentality, in all its forms, is that it completely forgoes the most powerful force in the universe for wealth creation: compounding. Compounding requires time. It requires a stable, long-term environment in which to work its magic. The trader is constantly pulling up the sapling to see if the roots are growing, and in doing so, ensures that it will never become a mighty oak. The direct financial connection of the permanent mindset is the full and awesome realization of compound interest, which Albert Einstein reportedly called the eighth wonder of the world. The numbers are so staggering they can be difficult to comprehend. Let's take a simple example. If you invest $10,000 and earn a respectable 15% annual return, after 10 years you will have about $40,000, a nice gain. But if you leave that same investment to compound for 40 years, you will have over $2.6 million. The last decade of compounding alone generates far more wealth than the first 3 decades combined. The trader's mentality, with its constant buying and selling, never allows this exponential curve to take hold. They live on the flat, early part of the curve, constantly restarting the process and paying taxes and fees along the way, which further dampens their returns. The permanent mindset is a strategy designed to ride the entire compounding curve all the way up. On a business's balance sheet, this principle is reflected in the growth of intangible assets like brand equity and customer goodwill. These assets are not built overnight. They are the result of decades of consistent quality, reliable service, and trust. A company like Coca-Cola has a brand value that is worth many billions of dollars, an asset that has been compounded through a century of consistent execution. The flipper entrepreneur, by selling their business early, sells the right to this future compounding for a relatively small, one-time payment. They sell the farm for the price of a single year's harvest, Furthermore, a permanent mindset in a business allows for long-term investments in R&D and infrastructure that would be unjustifiable under a short-term framework. This is how companies like Amazon could lose money for years while building a dominant global logistics network, an investment that is now paying off handsomely and has created one of the widest competitive moats in business history. Ultimately, the financial advantage of permanence is the difference between linear and exponential growth. The trader, the flipper, the job hopper, they are on a linear path, trading their time for money in a series of discrete transactions. The long-term investor, the legacy-building entrepreneur, the master of a craft, they are on an exponential path. They are planting seeds that, with the magical ingredient of time, will grow into vast forests of wealth, expertise, and influence. This is the final promise of the 20-slot rule: to transform your decision-making from a series of short-term bets into a small number of permanent, compounding pillars upon which a true empire can be built. You have just journeyed through the 5 foundational pillars of Warren Buffett's most powerful secret. You have installed a new operating system for decision-making. You now possess a mental model that acts as a filter, automatically eliminating the 99% of distractions that pull others into mediocrity and allowing you to focus only on the truly consequential. You have the scarcity mindset to raise your standards, the discipline of deliberate omission to protect your focus, the unassailable threshold of conviction to guide your choices, the strategic imperative of concentration to magnify your results, and the compounding force of permanence to build lasting wealth. This is more than just a set of tips, it is a complete architecture for achievement, but understanding this architecture is only the first step. The 20-slot rule is the what, the framework that dictates which actions to take and which to avoid. It is the perfect system for allocating your capital and your focus, but it doesn't fully illuminate the how. How did Buffett develop the analytical skill to look at the Washington Post and see a $400 million company when the rest of the world saw only $80 million? How did he gain the unshakable confidence to pour 40% of his partnership's money into American Express when everyone else was predicting bankruptcy? That is a different, but deeply interconnected, mental model. It is the engine that powers the 20-slot filter. It is the specific analytical framework he uses to calculate the intrinsic value of a business, to understand its competitive moat, and to project its future with a reasonable degree of certainty. The video that is now on your screen is the next piece of that map. It is the bridge between knowing you need to be selective and having the deep, analytical toolkit to make those selections with the same certainty as the master himself. This journey of intellectual ascent is not for everyone. It is not for the dabbler or the hot tip taker. It is for the individual who is serious about building not just a portfolio, but an empire, a legacy. If that is you, then the choice is not just clear, it is an obligation to your own ambition. Do not simply watch another video. Continue the deliberate assembly of your mental arsenal. The next critical component is waiting for you. Click and continue your ascent.